There are 21 chapters in this book. Introduction. If someone gave you $1 for every new fangled stock picking method invented every year, well, you probably won't need a book on investing. You would already be rich. Investors are constantly barraged with new ways to pick stocks and buy stocks. There are no shortage of pundits, professional investors, and traders who all can claim to know the best ways to invest. The trouble is, most of their advice is conflicting and often confusing. Maybe it's this constant swirl of investing babble that tempted you to pick up this book. If so, you made a wise decision. This book will help you get back to the basic of investing, understand business, and measures how much that business is really worth. Rather than chasing hot stock that whip around, Fundamental Analysis for Dummies will show you how to study the value of a business. You will then use that information to make intelligent decisions about how to invest. While Faddy's stock picking system come and go, fundamental analysis has been around for decades. The ability to pore over a company's most basic data and get a good idea of how a company is doing, how skilled the management team is, and whether or not a company has resources to stay in business is valuable skill to have. Fundamental analysis is best known as a tool for investors trying to get a very detailed assessment of what a company is worth. But you might be surprised to learn you don't have to be an investor to use fundamental analysis. If you buy a warranty from a company and want to know if the company will able to honor it, that calls for fundamental analysis. If you just want to know how well a company is doing, you might also want to use fundamental analysis. Journalists too can use fundamental analysis to find stories that will interest readers. Fundamental analysis also help you figure out whether you read about companies make sense. The aim of this book is to show you what fundamental analysis is and help you use it as a way to better understand business and investment. About this book. Fundamental Analysis for Dummies is one of the most approachable texts to tackle this somewhat complex topic. Rather than bog you down with the nitty-gritty details that academics pull their hair over, I have attempted to lay out all the main topics and techniques you will need to apply fundamental analysis to a variety of business tasks. While fundamental analysis is useful for anyone with genuine interest in learning more about business, I appreciate the fact you are likely hoping to make some money from fundamental analysis. For that reason, the book is largely targeted toward investors who are either hoping to use fundamental analysis to manage their portfolios or to enhance their current system of selecting stocks. As the author, I can share the tricks, tips, and secrets I have learned from a career writing about online investing for readers just like you. In the course of writing for USA Today, including a daily online column about investing called Ask Matt at www.usatoday.com. I have answered thousands of readers' questions that may include the same ones you have. Fundamental Analysis for Dummies give you all the tools you need to access fundamental data, process it, and make decisions. The book, however, stops short of showing you how to actually buy or sell stocks by choosing a broker and entering orders. If you are interested in the actual process of buying or selling a stock, the topic is covered exhaustively in my other book, Investing Online for Dummies. Icon used in this book. When you are flipping through this book, you might notice several icons that catch your attention. That's done on purpose. I use several distinct icons to alert you to decisions of the book that stand out. Those icons are as follows. Remember, these icons highlighted info that you should itch on the top of your brain and never forget even you are getting caught up in the excitement of fundamental analysis. Tip. Read this section to quickly pick up insider secrets that can boost your success with fundamental analysis. Technical stuff. Some of the things covered in the book get a bit hairy and complicated. This icon flags such sections for two reasons. First, you made decision to avoid the headache and skip over them because the information is not vital to your understanding of fundamental analysis. Second, the icon is a heads up that the paragraph is probably loaded with investment jargon. Don't embarrassed if you need to read the section a second or third time. Hey, you did not want this book to be easy, did you? Warning about the landmines scattered throughout Wall Street that can decimate your crown good intention at building wealth with these sections. Beyond the book. In addition to what you are reading right now, this product also comes with a free access anywhere cheat sheet that clues you in stuff like knowing the key SEC filing, goes over financial ratios to know and love, and offers a financial analyst mini dictionary. To get this cheat sheet, simply go to www.dummies.com and search for Financial Analysis for Dummies cheat sheet in search box. Where to go from where? If you are a new investor or just curious about fundamental analysis, you might consider starting from the beginning. That way, you will be ready for some of the more advanced topics I introduced later in the book. If you have already been using fundamental analysis or wondering if fundamental analysis might enhance a strategy you think is working for you, you might skip to part 2. And if you are dying to know about a specific topic, there is nothing wrong with looking up those terms in the index and flipping to the appropriate page. Part 1. What fundamental analysis is and why you should use it. In this part, find out how understanding the way a company makes money can help you make money. See how fundamental analysis compare with other ways of investing. Check out how some successful investors put fundamental analysis to work. Understand the accounting procedures companies use to record their fundamental for all to see. Chapter 1. Understanding Fundamental Analysis. In this chapter, getting a solid overview of why fundamental analysis is worth your time, stepping through some of the main concepts that are critical to fundamental analysis, understanding the ways that fundamental analysis can fit into many investment strategies, grasping how to use this book to further your understanding of fundamental analysis. Before you gulp down that neon colored energy drink or pour yourself a bowl of super sweetened krill that looks like it was made by Willy Wonka himself, you probably do something first. It's probably not a bad idea to take a glance at the nutrition label that spells out what ingredients are in the box. You might not know what guarana or other ingredients that often shows up on the label of such processed foods are, but you can get a pretty good idea of what's for you and what's not. If a bottle of apple juice, for instance, has a list of ingredients longer than your arm and is filled with stuff you can't pronounce, you know you are not drinking squeezed apples. Being aware of what's in a food may or may not sway your decision to eat, but at least you know what you are putting into your body. Companies as stock, too, come with similar labels. All companies that are publicly traded or that take investment money from the public are required to disclose what they are all about. Just as food processors must list all the ingredients that go into their product, companies must tell investors what are they composed of. Unfortunately, all the information investors need to know about a company does not flip inside a teeny rectangle like it does on a food label. Instead, the key elements that make a company are broken down at length in a series of financial statements and other sources of fundamental data. Reading these critical financial statements and gleaning insight from them are the most basic goals of fundamental analysis. Fundamental analysis is the skill of reading through all the information companies provided about themselves to make intelligent decisions. Just as you would want to know what's in the Frankfurt you are about to bite into, you want to know what is in investment you are thinking about adding to your portfolio. Why bother with fundamental analysis? You might wonder why you need to hassle with fundamental analysis. After all, at every family picnic, here is undoubtedly the loud-mouthed relative who is filled with all sorts of can't go wrong stock tips. Why bother with technical thing like net income or discounted cash flow analysis when you can just turn on the TV or write down a couple of stock symbols, buy the stocks, and hope for the best? You might also figure learning how companies operate is just needless information. After all, you don't need to know about fuel injection system, suspension, and car battery technology to drive a car. And you don't need to know what's going on behind the curtain to enjoy a play. Some investors figure they can just pick a couple of hot stocks, buy them, and drive off to riches. Remember, if the vicious bear market that began in 2007 taught investors anything, it's had blindly buying a stock just because you might like a company or its product was hardly a sound way to tune up a portfolio. Chasing hunches and personal opinion about a stock is often not a great way to invest, and you will find out in chapter 20. The financial crisis is now becoming a distant memory for many investors who might again think fundamental analysis does not matter. Investors have taken to chasing stories and hype again in the bull market that kicked off in 2011, and most or certainly many of those can't go wrong. Investments will meet a poor fate as the fundamental catches up to reality. Some of the real values of fundamental analysis. Ever notice how there is always a new wonder right promising to make you skinny and new pill to make you healthier more times than not? Thought. It seems these things never work. Getting healthy comes back to the basics. A balanced diet and exercise. The same goes with investing. Believe it or not, investing can be somewhat full of fates. There is always a new investment pundit or economists with a novel way to picking winning stocks. And just as an hour on the treadmill will do you more good than a bottle full of miracle pills, successfully choosing a stock often comes back to fundamental analysis. Fundamental analysis is a classical way to examine companies and investments for a variety of reasons, including the fact it is based on fact, not opinion. It's easy to get caught up in general enthusiasm about what a company is doing or the products it's selling. Fundamental analysis blinds you to invest hype and get you into focus on cold hard business realities. It does not matter if all the kids in your neighborhood are buying a company's product if the company is not making any money at selling them. Good at pinpointing shifts in the business health. If a company's success is starting to fade, you will see it show up in the fundamentals. No, there won't be a giant sign saying sell this stock, but there are clues if you know how to look, and as you will discover in chapter 18, companies are required to disclose key aspects of their business, so if there is a problem, a fundamental analyst will often be early at spotting some trouble. All about execution. Companies CEO are usually good at getting investors focused on the future and how things are going to get better next quarter, but fundamentals are based on reality right now. Just think of children who say how hard they are working at school. The report card is still the tangible evidence of how things are actually going. The numbers don't lie if you know where to look. A way to put price tags on companies. What's painting worth? What a used car worth? The price of an asset with a subjective value is generally what someone else is willing to pay for it. The stock market and auction of buyers and sellers does a good job putting price tags on companies, but fundamental analysis gives you another way to see just how much investors by buying or selling stock are paying for a stock. Driving home an example. One of the best recent example of how fundamental analysis can help you and your portfolio is General Motors. For decades, GM represented the might of US industriousness, know-how, and creativity. GM commanded a massive market value of $3.5 billion in 1928, says Standards and Poor's. I will step you through what market value means in more detail in chapter 3. But for now, you just know that GM was the most valuable company by far in 1928. For decades, investors figured a dollar invested in GM was money in the bank. The company slugged through upturns and downturns and was a lasting power that helped drive the US economy. The company kept paying fat dividends and kept powering profits higher. There was even an expression as GM goes, so goes the nation. But investors who blindly gave GM would remain a lasting force and ignore the fundamental signs of trouble suffered a brutal blow on June 1, 2009. On that day, which will forever remain one of the lowlights of capitalism, GM became the fourth largest public company to seek bankruptcy protection. According to bankruptcydata.com, shares of GM stock collapsed to just 75 cents a share, down 97% from their level just 3 years before. Fundamental analysis may not have helped you predict just how shocking GM's fate would be, but concrete elements from the company's financial statement could have tipped you off to just how challenged GM was well before it became a penny stock and was liquidated. GM was ultimately reborn when a new company was created and bought many of the old company's assets, including the GM name. You can be sure that investors in the new GM paid much closer attention to the fundamentals. GM versus Ford. Even months before GM filed for bankruptcy protection, fundamental analysis could have served you well. Back in January 2009, seeing both GM and Ford facing intense financial strain, many investors wondered if either one was worth taking a bet on. Some helpful fundamental analysis tools, including analysis of the statement of cash flows, could have determined whether you lost a fortune or enjoyed a big gain. I will show you how to read the statement of cash flow in detail in chapter 7, but for now I am just giving you a real example of why fundamental analysis matters to win your appetite. At the beginning of 2009, both Ford and GM were constantly in the news. Both faced a tough business climate and both had depressed stock prices. Ford began 2009 at $2.46 a share and GM $3.65. The market clearly saw big time trouble at both firms, but a quick fundamental analysis showed Ford was the much better bet. Ford ended the quarter with $27.5 billion in cash and burned $600 million in cash. Don't let the numbers scare you at this point. I am just exposing you to a basic free cash flow analysis as you will learn about later. Just for now, know that the quarterly rate Ford had enough cash to last nearly 46 quarters. Over at GM, however, the company ended the quarter with just $15.9 billion in cash. Meanwhile, it burned through $8.9 billion during the quarter. A fundamental analyst knew right away the company was not going to make it through the year at that rate. That's critical information to have known. Knowing how to do this one type of fundamental analysis made a world of difference for investors. In the following 6 months, shares of Ford jumped 149% to $6.13. Ford also did not accept government funding assistance. By the end of 2014, Ford's share bounced back to about $15 a share. Meanwhile, shares of GM crashed 79% to 75 cents. The company was renamed Motor Liquidation Company Its assets were sold off and investors were decimated. Makes you want to read the rest of the book, does not it? Putting fundamental analysis to work. It's easy to get consumed with the fast money trading aspects of stocks. Exciting TV reports about a stock on the move and companies that have new products practically turn investing into a sporting event. If you listen to some traders talk, they rattle off companies' ticker symbols in rapid fire delivery just as sport fans talk about teams. Flashing arrows and rapid trading can become an addiction for people who get into it. Fundamental analysis is trying to help you avoid these headaches and insanity. Stocks rise and fall each minute, day and week based on a random flows of news. That's mostly noise to a fundamental analyst. The constant ups and downs of a stock can sometimes confound logic and reason. Many readers of my Ask Matt column at usatoday.com are baffled when stock falls even after the company reports what appears to be good news. Trying to profit from these short-term swings is a game for gamblers and speculators. It's a footlight on a long-term basis. But that's not to say investing is gambling. Remember that those stock symbols you see flashing red and green are not dice, horses, or cards. They are more than just the 2, 3, or 4 letters of their ticker symbol. When you buy a stock, you are buying a piece of ownership in companies that make and sell products and services. You are buying a claim to companies' future profits. Owning a piece of a real business over time is not gambling, it's capitalism. Remember, fundamental analysis forces you to focus on investing in businesses, not stocks. You are not buying a lottery ticket but a piece of ownership in an actual company. Sometimes this gets lost by investors who pay more attention to stock charts than to financial statements. If jumping in and out of a stock at the right time is not the way to riches, then what is the trick to be successful in investing? The answer is to stop thinking of stock as just symbols that generate each day. The goal of fundamental analysis is to help you step away from the short-term trading and gambling of stocks. Instead, you approach investing as if you are buying a business, not rolling the dice. Fundamental analysis ideally helps you identify businesses that sell goods and services for more than what they paid to produce them. Fundamental analysis is your tool to evaluate how good a company is doing as at turning raw material into profits. If there is an investor who best personifies fundamental analysis over speculation, it's famed investor Warren Buffett of Berkshire Hathaway. Buffett is one of the most known users of fundamental analysis. In fact, he is so confident in his analysis of a business, he will often buy very large stake and hold on to it for decades. You will read more about how Buffett applies fundamental analysis to investing in Chapter 3. Tip: no matter how choose investment currently, you can likely apply fundamental analysis even if you are kind of investors who like to buy diversified mutual funds and hold on to them forever. Called a passive investor, it can be helpful to understand basic financial characteristics of the companies. Knowing what fundamental to look for. Knowing what makes a company tick is not as convoluted as it may sound. Companies are so regulated and scrutinized. All the things you need to pay attention to are usually listed and published for all to see. Generally, when you hear about a company's fundamentals, the key element to be concerned with fall into several categories, including financial performance. Here, you are looking at how much a company collects from customers who buy its products or services and how much it keeps in profit. Terms you probably hear quite a bit about, such as earning and revenue, are examples of ways fundamental analysts evaluate a company's financial performance. Financial resources. It is not enough for a company to sell goods and services. It's not even enough to turn a profit. Companies must have also the financial firepower to invest in themselves and keep their business going and growing. Aspects of a business such as its assets and liabilities are ways to measure the company's resources. Management team. When you invest in a company, you are entrusting your money to the CEO and other managers to put your cash to work. Fundamental analysis helps you separate the good manager from the bad. Valuation. It's not enough to identify which companies are best. What's a good company anyway? Definition of good can run the gamut. You also need to consider how much you are paying to own a business of piece of a company. If you overpay for the best company on the planet, it's still likely you will end up losing money on the investment. You will read more about valuation in chapter 10 and chapter 11. Macro trends. No company operates in a vacuum. A company's performance is highly influenced by actions of competitors or the conditions of the economy. These bold factors need to be incorporated into fundamental analysis, as you will discover in chapter 15 and chapter 16. Knowing what you need. One of the great things about running as a hobby is all you need is a pair of decent shoes and basketball. Just grab a ball and find a hoop. No fancy equipment is required. The same goes with fundamental analysis. Much of the data you need is provided free by companies and can be accessed in seconds from any computer connected to the internet. Fundamental analysis can get pretty involved, but in its most basic form, fundamental analysis had just a few basic ideas behind it, including awareness of the benefit. Because fundamental analysis takes some know-how and time spent learning a bit, you will want to know ahead of time why you are going to trouble. Chapter 2 and 3 highlight the payoff of fundamental analysis. Even if you are a passive investor or one who simply buys a basket of stocks and holds on, there are reasons why fundamental analysis might be worth your while. Retrieval of financial data. Getting all the key data you need to apply fundamental analysis is easy if you know where to look. Chapter 4 gives you quick tips on how to round up all the company financial data you will need. Basic math. There it is, the M word. There is no way around the fact there will be some number crunching involved in some aspects of fundamental analysis. Don't worry, I will guide you to help keep the math as painless as possible. Knowing the tools of fundamental analysis straight. You can read all sorts of books on how repair and even a trip to your hardware store and buy lots of screws, nails and glue, but none of that effort will benefit you unless you have a tool belt and the knowledge of how to get started and put your plan into reality. The some importance of execution is a part of fundamental analysis. You may appreciate the importance of fundamental analysis and may even be able to download fundamental data from the website or from a company's annual report, but you need to have the tools to analyze the fundamentals to get any real value from them. Staying focused on the bottom line. If there is one thing investors may agree is of utmost importance, it is the company's profitability. When it comes down to it, when you invest in a stock, you are buying a piece of the company's earnings. Knowing how to read and understand how much profit a company is making is very important when it comes to knowing whether or not to invest. The income statement, described in full detail in chapter 5, will be your guide when you are trying to determine how profitable a company is. What might also surprise you is that the income statement can tell you a great deal about a company in addition to just know how much income it brings in. Seizing up what a company has to its name. During times of intense financial stress, investors often make a very important mental shift. They are not so concerned about making money as they are about just getting their money back. Similarly, when things get tough in the economy, investors are less interested in how profitable a company is and are more mindful of whether a company will survive in the economy downturn. When you are trying to understand the lasting power of a company, fundamental analysis is of great value. By reading the company's balance sheet, you can get a rundown of what a company has, its assets, and what it owes, its liabilities. Monitoring these items gives you a very good picture of how much financial dry powder a company has to endure a tough period. Chapter 6: Explore the balance sheet in more detail. Burn, baby, burn, cash burn. One of the biggest killers of companies, especially smaller firms just starting out, is poor cash flow. When a company might have a great product concept, excellent management, and even dedicated financial backers, timing is everything. If a company is using up cash to pay its bill and employees but not bringing in enough cold, hard cash from customers, it can run into a giant financial headache very quickly and not have enough cash to reach its potential. Tip: if there is one thing I hope you pick up from this book, it's how fundamental analysis helps you keep a close eye on how much cash is coming into and out of a company. Monitoring cash flow is critical to know if a company is running previously empty on cash, which you will dig into in more detail in Chapter 7. Tracking a company's cash flow is also a very important way. Fundamental analysis helps you put a price tag on that company, as you will find out about in Chapter 11. Financial ratio. Your friend is making sense of a company. As you flip through this book and jump around to different topics that interested you, you might be a bit bewildered by just how many pieces of financial data fundamental analysis must deal with. You have got the financial statement that measures just about every aspect of a company. It can be intimidating to decide what numbers matter most and which ones can be ignored. Financial ratios will be great help here. As you will see in Chapter 8, these ratios draw all sorts of fundamental data from different sources and put them into perspective. Financial ratios are also important because they form the vocabulary of fundamental analysis. If you are ever at a cocktail party where analysts are talking about gross margin and accounts receivable turnover, I want you to be prepared. By the way, that sounds like a pretty boring party. I will show you a whole host of financial ratios in Chapter 8 that are the favorite used by many financial analysts. You will soon be using a seemingly unrelated pieces of financial data about a company to clean some very important conclusions about the company. Making fundamental analysis work for you. Imagine a young child who memorized an entire dictionary but can't use a single word in a sentence. That's basic analogy of some investors. Fundamental analysis knowledge. You might to know some things about their income statement and balance sheet and have a great knowledge of what's contained in the statement. But when it comes to apply your know-how, that can be a bit trickier. Putting fundamental analysis in action requires taking everything you know about a company and mixing in some estimates and best guesses about the future to arrive at a decent expectations of whether or not to invest in a company. Using fundamentals as signals to buy or sell. Buying a stock at the right time is very difficult, but knowing when to sell it is even tougher. And while fundamental analysis won't tell you the exact best time and day to buy or sell stock, it can at least give you a better understanding of things to look out for when it comes to making decision. Tip: if you are a passive investor and buy large basket of stocks such as those in the Standard and Poor 500 index, you can afford to buy and hold the stock as a group. Even if one company runs into big trouble, it's just one holding in a large basket of stock and not all that catastrophic. However, if you choose to invest in individual stock trying to pick companies you think will beat the market, monitoring the fundamental is critical. If you start noticing a company's trend de- deteriorating, you don't want to be the last investor to get out. The perils of ignoring the fundamentals. Blindly following a company and investing in the stock can be very dangerous. If you pick the wrong one, the dot-com bubble and subsequent financial crisis of 2008 and 9 are still the best recent example of how ugly things can get for investors who buy what's popular and ignore the fundamentals. Table 1.1 shows a list of few major US stocks that were worth $100 a share more at the beginning of 2000, but saw their share price fall to below $10 a share by the start of 2009. Ouch. Avoiding stock disasters like those in Table 1.1 is one thing that makes fundamental analysis so powerful. Losses that last are nearly impossible to recover from a single person's lifetime. You can read more about why avoiding investment disaster is so critical in Chapter 18. Using fundamental analysis as your guide. As Table 1.1 shows, investing in individual stock is very risky. Losses can be seizable. That's why if you are going to buy individual stock, you want to invest with your eye wide open. Just as you probably won't dare fire a loaded weapon or jump out of an airplane without proper training, the same goes with the investing in individual stocks. Luckily, fundamental analysis provides investors with a host of very specific tools to help them protect themselves. And while the tools of fundamental analysis are not bulletproof, they give investors guidance of when a stock might be getting a little dangerous or the underlying trends might be changing. Hopefully, by reading this chapter, you will see why fundamental analysis is so important and be eager to see how the rest of the book can help you. You will find complete explanation of some of the most powerful tools used by fundamental analysis in this book. Chapter 11, for instance, will be very valuable to you because it shows you how to use a company's cash flow as a way to measure its value. And in chapter 12, you will discover how the process spins through the annual reports they receive from companies. Chapter 2, Getting Up to Speed with Fundamental Analysis. In this chapter, comprehending what fundamental analysis is and how it can help your portfolio, finding out what's involved in using fundamental analysis, comparing fundamental analysis with other ways of selecting investments, getting an understanding of what tools are needed to analyze an investment. Try to remember what is was liking begin a beginner at something you are good at now. Whether it was a karate, ballet, or basketball as a beginner, you may have been tempted to bypass all the basic and go straight for the advanced techniques. It's natural to want to try breaking boards with your bare hand or doing pirouettes or slam dunks on your first day of trying something new. Good coaches, though, encourage you to slow down and start from the very beginning. It's almost always best to start working on the basic karate stances, ballet poses, and basketball driving before even thinking about moving to the showy and advanced aspects of each sport. Beginning investors often experience a similar overconfidence at first. Many hope they can skip mundane things like reading accounting statement, understanding basic financial ratios, and calculating discounted cash flows models and get right to the exhaustive rapid fire trading. It's tempting to think you can trade complex securities, dabble in highly volatile stocks, and dart in and out of investment with ease right away. Realistically, though, investors usually lose money when they try to get too advanced too soon. And unfortunately, there is no cost to pull of investors who are just starting out. So consider this book to be your coach. Begin. This book will introduce you to the basic skills that make up fundamental analysis. The basic explained in this chapter will set up for taking fundamental analysis to the next level in chapters deeper in the story. What is fundamental analysis? Ask 20 people how they choose their investments, and you will probably hear 20 different methods. Some like to buy stocks recommended by a friend or broker. Other thinks it's wise to invest in companies making products they are personally enjoy and use. A few even consult with astrologers seriously. What most people have in common is that they feel they are always paying too much for a stock and selling them when they are too cheap. Perhaps you swing between different uh, investment strategies, like some folks switch diets to lose weight. Experimenting with different ways of picking a stock may have worked fine as stock made breathtaking advances in 1990s. But the financial crisis of 2008 and 2009 changed everything, serving up a harsh reminder to many investors today that it is impossible to overpay for stocks, not realizing that ahead of time can be hazardous to your portfolio, and perhaps after losing money a few too many times, you are looking for a method with a little more science behind it. That's where fundamental analysis comes in. Fundamental analysis is one of the most sound and primary ways to evaluate investments. As a fundamental analyst, you carefully and thoroughly study every aspect of company's operations. Much of your analysis will be focused on financial statements companies provided described briefly in this chapter and in more detail later on in the book. Going beyond betting. If you're like most investors, even the worst fundamental analysis may turn you off a bit. Fundamental analysis sounds somewhat stuffy and academic, and it's true that fundamental analysis finds much of its roots in academia. But you might be surprised to find you probably are using some basic form of fundamental analysis in your life, perhaps even in place you won't expect. One of my favorite examples of where a type of fundamental analysis is used is that at the horse races. Before a horse race, you will notice group of waiters doing some serious work trying to pick up the day's winning horses. Some may, moreover, serious work trying to pick up day's winning horses. Some pour over the life histories of horses in the race, getting to know the jockeys and their techniques, and e- even studying how wet or dry the track is. Although investing is not exactly like horse racing, the analogy is a helpful way to understand fundamental analysis. For instance, some fundamental analyst will study a company like a waiter will study a horse. How successful has the company been recently? And is it healthy and well cared for? Next, in fundamental analysis, you might study a company's management like a waiter would consider the jockey. Is the management experienced and has it competed against rivals before like the ones it's facing now? Lastly, you must evaluate the broad economic climate, just like a veteran will consider the weather and condition of the track. But here's where things get even trickier. It's not good enough to find the best company or horse to take the metaphor a little further. After all, if all the other bettors at the track did the same work and picked the same horse that you selected, you have a problem. The odds would be adjusted so that the payout on the favorite horse will fall. Bettors know that picking a favorite horse to win does not pay off much, and you are also taking a chance that the favorite will surprise almost everyone by losing and cost your money. Similarly, if you invest in a company that's widely considered to be darling with other investors, your payoff is reduced for reasons you can discover in chapter 3. Now, that you see what fundamental analysis is broadly speaking, consider how it can be applied to investing. Fundamental analysis is used to size up investment in several key ways. Analyzing the financial statements. Fundamental analysts pore over public document companies provide to understand how the business is performing. Many fundamental analysts' starting point is digging into a company's financial statement to see how profitable a company is, how rapidly it is growing, what kind of financial health it is in, and whether it has the ability to withstand tough economic times. Getting an idea of how solid a company is. Many fundamental analysts are fixed income investors. These investors have loaned money to companies usually by buying bonds. Bond investors give money to a company in exchange for an agreed upon payment each month, quarter, or year. Because bond investors get a fixed amount of fee, they don't care if a company is widely successful. Bond investors, unlike stock investors, don't get a share of future earning and growth. Bond investors just want to know the company is healthy enough so it can keep paying interest and return the money is borrowed. Understanding the value of a company. Stock investors use fundamental analysis to gauge whether a company's stock is a good deal or not. By studying financial statement, financial analysts determine whether a stock's price undervalues or overvalues the company. You can find out how to value a company using the discounted cash flow analysis prepared with fundamental analysts in chapter 11. Going beyond the financials. Fundamental analysis goes beyond where accounting stops. Accountants' goal is to precisely measure business activity. Fundamental analysts are looking for much more. They want to understand how a business actually works and what its growth. Using fundamental analysis, you will evaluate other factors that affect a company's prospectus that go beyond what an accountant would care about. Common factors we might consider include sizing up a company against its rivals, determining how skilled a company's management team is in navigating through boom and bust times, understanding the broad economic climate. Comparing a company's performance with its industry and competitors. A company's value, financial resources, or performance is measured relative to its peers. Fundamental analysis will show you how to not just size up the company you are interested in, but see how it measures up with companies it is competing with. Remember, fundamental analysts take all the intelligence they gather to arrive at an investment decision and to take actions. The most common question fundamental analysts ask themselves is whether a stock at its current price is cheap or expensive. The answer to that question will determine whether you choose to invest or not. Understanding how fundamental analysis works. Fundamental analysts often dig well beyond a company's financial statement and try to unhear things. Sometimes fundamental analysts might spot a trend forming before company's management acknowledges it. A fundamental analysis, for instance, might visit a retailer's store and see how crowded they are to get an idea of what earning might be in the future. Similarly, the fundamental analyst may try to get an idea of future demand by considering how busy a company's suppliers are. The goal of fundamental analysis is to measure how much a company is worth by using any sort of information possible. The way you use fundamental analysis to understand what a company is worth gets down to the core essence of what a business is. With fundamental analysis, your goal is to monitor a company to see how it brings in money by selling goods and services to generate revenue. Next, you will determine how much of revenue a company manages to keep after paying its expenses. What's left after paying all the bills is profit or earnings. Remember, the fact that fundamental analysts take action on their research is what separates them from accountants. Fundamental analysts compare what they think a company is worth with what other investors think. If the stock is undervalued, the fundamental analyst will buy the stock. Accountant, on the other hand, have the job of recording sales and revenue but not trying to profit off their findings. Tip: fundamental analysis is not perfect, but as you will discover in this chapter, fundamental analysis is rigorous and rooted in understanding the most basic elements of business. Even if you have no plans to be a fundamental analyst, knowing how fundamental analysis works can only boost your investment success. Accountants are not supposed to be stock pickers. Accountants who step over the line and try to profit from fundamental analysis can get themselves into trouble. Most accounting firms have a strict rule that prohibit employees from owning share of companies the firm keeps the books for. Knowing the fundamentals of a company is so powerful that the knowledge of can give accountants material and non-public information that would amount to inside information that would be illegal to profit from. Just ask former KPMG accountant Scott London. London was charged of tipping a friend with fundamental details of 5 KPMG clients in 2013, which his friend used to make more than $1.2 million in profit riding ahead of profit report and merge deals. According to the section in Exchange, London's friend gave him bags of cash and a pricey Rolex watch. It's a great example that shows how fundamental analysts and accountants have very different needs from financial statements. Who can perform fundamental analysis? You don't have to be a high-powered investor to use fundamental analysis. If you have an interest in finding out more deeply about how companies work, you are a candidate for learning about fundamental analysis. In fact, knowing how to read, analyze, and take action from information you glean about a company can be helpful for many users, including stock investors. Those looking to take an ownership stake in a company have a great financial incentive to master fundamental analysis. What they find out about companies may help them to decide when a good time to buy or sell may be. Lenders: when you give someone a loan, you want to ensure they have the ability to pay you back. If you lend money to a company, perhaps by buying bonds, it shows you are more concerned about getting your money back than about making a killing on the investments. Mutual fund investors: even if you don't pick individual stock or bonds to invest in, you probably own mutual fund that too. Mutual funds are the investment that invest in a basket of individual securities. Using fundamental analysis, you can investigate some of the stock your mutual fund may own. You might take a look at the top holdings of your mutual fund and question why your mutual fund owns them. Employees: Workers may be anxious about the health of their company for several reasons. Using the same technique as investors would use, you can study your company's financial resources and roughly estimate how likely it might to be pursue aggressive cost cutting like layoffs. Employees who depend on a pension paid by a former employer might also want to study the health of companies and make sure it will stick around. Board member. Whether you are board member of a large company, your local museum, or your condominium association, understanding the flow of money in and out can make you more valuable. Understanding fundamental analysis will help you be a solid watchdog of the organization management by looking at facts, not promises. Donors. Even some non-profit charities disclose their financial standing. Fundamental analysis will help you see where donations are being spent and whether or not money is getting to those in need or being soaked up by the bureaucracy. Consumers. When you buy a product or service, you may not think of yourself as investing in a company. Most of the time, you are not. But sometimes, by buying a product, you are forming a long term relationship with a company. Take a car or an insurance product. These type of long-lived assets can attach you to hip of the company for years. It's a good idea to know how to analyze a company if you plan on rely on its products for a long time. Above all, fundamental analysis are good at not getting hoodwinked by companies. That's not a bad skill to have. You can't always take the financial statement at face value. Fundamental analysis gives you the tools you will need to get to the truth behind the numbers. Remember, fundamental analysts spend quite a bit of time looking at companies' financial statements, as you will learn in part 2 of this book. But skilled fundamental analysts do more than just pick apart financial statements. After all, if that's all it was, fundamental analysis would be synonymous with accounting. Fundamental analysts use their finding to make investment decisions following the money using fundamentals. One of the basic rules of investing journalism is following the money. Tracing the movement of dollars through an organization will quickly so to the motive of leaders, availability of resources, and vulnerabilities. Regulators will often follow the movement of money to pinpoint illegal cartels, Ponzi schemes, and other frauds. Tip: all this might sound very clock and jagger, but there is something to be learned from approaching fundamental analysis with the mind of an investigator. Your job is to take available information and dig up data yourself to get a complete picture of a company and whether or not it's a suitable place for you to trust your money. Following the way money moves through a company will tell you more about it than just about anything else. While no two companies are the same, the basics of business are universal. That's why fundamental analysis is such a powerful tool you can apply to high tech companies, low tech companies, and everything in between. Tip: companies are merely in the business of selling things they acquire for more than what they paid. Sounds simple, but that can be easy to forget after you get mired in detail like profit margin, earning per share, and PE ratios. Following the money at a company, so to speak, traces a predictable cycle. Just like the cycle or life repeat and rephrases, companies follow a pretty predictable pattern too. Fundamental analysts call this the trade cycle, and understanding the cycle is pretty important if you want the financial statement to make sense. The trade cycle begins with a business idea, but more specifically, it starts when a company raises money so it can buy the equipment it needs to get started. Money might be raised by borrowing it, called debt, by lining up the investor willing to bet their money for a piece of future profits, called equity. The money raised is then used to acquire raw materials, office spaces, or whatever the company needs. Next, the company tries to add value to the raw material in some way and sell the product to customers. Typically, companies will also incur indirect cost or overhead to make all this happen. Overhead costs include everything from advertising to research and development to hiring skilled managers. Their, the product are created and hopefully sold to the consumers. The cash collected from customers is then used to repay debt. The cycle then repeat all over is not this fun. Now, here is where fundamental analysis comes in. Here are a few questions fundamental analysts might ask when taking a look at a company. After factoring in all the costs, did the company make money? How much money did the company raise to get started? Is the company able to maintain itself without borrowing more or getting more investors? Can the company create new products to keep buyers coming back? Are competitors catching on to the idea and selling a similar product for less? Comparing fundamental analysis with other ways of picking investments. Fundamental analysis is a well-known way of choosing investments. It's often the preferred method taught in business schools, largely because of its roots in things that can be measured and understood, but is not, by any means, the only method of choosing a stock. Tip: if you are still a little foggy on what fundamental analysis is, comparing it with other ways of evaluating investment might clear things up for you. How fundamental analysis stack up against index investing. If fundamental analysis seems like a lot of work, you can probably identify with index investors. Index investors think taking the time to pore over company's financial statement is a lot of trouble for nothing. Index investors figure any information to be gleaned from company report has already been extracted by other investors and acted upon. For instance, if a company's stock was truly undervalued, other investors will have already recognized it and bought the stock. If enough investors buy a stock, they push the price, and the shares are no longer undervalued. And thanks to the proliferation of electronic investing, analyze and investment firms with access to instantaneous information feeds can make such trading moves very quickly. For that reason, index investors think trying to buy and sell stock at just the right time or use market timing is impossible. In addition, index investors say that if there is an edge to fundamental analysis, it's wiped out by the cost and time consumed digging out the information. For that reason, index investors skip the fundamental analysis and instead diversify. Rather than trying to pick the companies and stock that will do best fundamental analysis buy a small stake in as many stock as possible. Generally, index investors will buy mutual funds that own hundreds, if not thousands, of stocks. That way, if any one company stumbles badly, the loss is very small as a percentage of the portfolio. Buy index funds. Because index fund investors don't think fundamental analysis gives investors an edge, they don't see any reason to pay a mutual fund manager to pick stocks for them. Instead, they buy a mutual fund that own all the stock in popular stock indexes such as the Dow Jones Industrial Average or a standard S&P 500. The Dow mirrors the ups and downs of 30 large, well-known companies, and the S&P 500 measures the market performance using 500 of the largest companies' shares. Focus on cost. Index investors assume the best way to make money in the stock market is keeping costs low. Index funds generally have low expenses, and rather than spending personal time in research a stock, index investors generally buy a diversified basket of stock and then forget about the holdings. Comparing fundamental analysis with technical analysis. Like index investors, investors who use technical analysis shake their heads in disapproval when they see fundamental analysts carefully examining a spreadsheet and financial statements. They, like index investors, see all the effort that goes into fundamental analysis as a waste of time and calculator batteries. That's because technical analysts assume an information worth knowing is reflected in a stock price. But technical analysts agree with the fundamental analyst one important way. They too think that they too think it's possible to beat the stock market, unlike index investors who think that the timing the market is futile. Technical analysts think the stock price move up and down in observable patterns. Knowing how to recognize pattern in stock price movements can signal technical analysts the best time to get in and out of stocks. Technical analysts may not even care what a company does because they are just looking at the price chart. To a technical analyst, buying and selling at the right time is more important than buying and selling the right stock. Technical analysts pay close attention to stock price charts. Technical analysts focus on stock price chart, which are graphs that plot a stock's movement over a period of time. This chart will show instantly whether stock is rising or falling in addition to how many trades or volume are occurring. Trading patterns. Much as an astronomer sees patterns of stars in the sky, technical analysts look for stock price movements and follow patterns. For instance, if a stock price falls to a low level, rise a bit and sinks back down to near that some low level, technical analysts call that a support level. A support level is considered a point where demand for a stock is strong enough to stop it from sinking much further. Moving average. Technical analysts often pay close attention to a stock's average price over a period of time, say 200 days. When a stock falls below its 200-day moving average or its average price over the past 200 days, that means the stock is vulnerable to fall further. Technicians say the idea is what? The idea is that when stock fall below their 200-day moving average, many investors who bought within the first year are losing money and may be nervous and quick to sell. Here is an easy way to keep fundamental analysis and technical analysis clear in your mind. Fundamental analysts are looking for what or the companies that are attractively priced. Fundamental analysis will often hold their investment for a long time. Technical analysis is more useful for the when. Technical analysts are usually just looking for opportunities time to try to profit from short-term moves. Putting fundamental analysis to work for you. If you ever see the library of a fundamental analyst, it can be pretty intimidating slide. Eventually, there will be a copy of Securities Analysis MC Gromil, a 766-page tom stuffed with canary formulas and arcane wording that make your high school algebra book look like a comic book. There will also be a dog-eared copies of books with word like value, financial statement, and ratios. You will see fundamental analysis for dummies on the shelf as well. Shameless plug, I know. Fundamental analysis has the rap of being for people who want to be counted without a pen, mechanical pencil, and calculator in their shirt pocket. But even if you don't want walk around carrying such instrument, you too can benefit from fundamental analysis with an understanding of few terms and basic techniques. Fundamental analysis is within reach if you are interested and willing to put it in a bit of time. Remember, who knows, maybe after reading this book you will want to dig deeper into fundamental analysis. After all, fundamental analysis is a bit like art. As you learn a little, you naturally get curious and want to learn more. How difficult is fundamental analysis? Do I need to be math wizard? Contrary to popular belief, you don't need to be a math wizard to use fundamental analysis. Most of the math you will use is pretty basic arithmetic, and there is no need to memorize formula because I will put most of the important one all together for you in chapter 8. You will need to know how to build some financial models which try to forecast how much profit a company will make in the future. But to help you out, I will point out some online tools and calculators to crunch some of the more tricky stuff for you. Tip: some of the more advanced techniques of fundamental analysis might require you to fire up a spreadsheet. If you want to get up to speed, Microsoft provides free help and tutorials for its Excel spreadsheet program. You might also take a look at Excel 2013 for Dummies. Is fundamental analysis for you? If you are tired of trusting other people to tell you how a company is doing financially, you are prime candidate for fundamental analysis. The whole premise of fundamental analysis is to reduce, if not eliminate, speculation and wild guesswork from investing. Fundamental analysis is rooted in the idea that you want to look at cold, hard data to make informed decisions why an investment might be worthwhile. If someone tells you a company is doing well, fundamental analysis gives you the background to know whether that claim is really true. Above all, fundamental analysis is ideal for people who want to approach an investment fully informed of the risk and with their eyes wide open. An in-depth fundamental analysis on a stock will not only alert you potentially troubling trends at a company, but also give you clues to whether a stock may be overvalued by investors who are not paying attention. An overvalued company is one that commands a stock price that well exceeds any possible profit it could generate for investors. In many ways, fundamental analysis is as much about helping you avoid poor investment as much as it about helping you find good ones. The risk of fundamental analysis. Fundamental analysis, while it's rooted in math and objective information, is not without its flaws. After all, if fundamental analysis were perfect, everyone would quit their day jobs, analyze stock, and make bundles of money. That's why it is important to understand the shortcoming of fundamental analysis, which include vulnerability to wrong data, including your assumptions. Fundamental analysis is heavily based in fact, but if a company incorrectly report data or you misinterpret them, you are going to have a false conclusion. Miscalculations are especially like when making assumptions about things like a company's future growth rate, future interest rate, or profits. Even fundamental analysts are human, over reliance on past data. Perhaps the biggest knock against fundamental analysis is how much weight it puts in a company's past performance. There is some truth to that, because numbers companies report can be month or more old. However, true fundamental analysis use historical number to make an educated guess about the future. Bad timing. Let's say you do all the homework in researching a stock, you find a stock that appears to be screaming buy, so you buy it. Guess what? The stock can remain screaming buy for many years or even decades until investors come to the same conclusion. Fundamental analysts often have to be wrong for a long time before making money. Betting against the market. If you buy a stock because you think it's a steal, you are in fact betting against thousands of the most sophisticated trading desks around the world with access to the same data. If you think a stock is too cheap, you are making the gamble that other investors are missing something you can see. Concentrated positions. If you are going to the trouble to meticulously study a company, you are going to want to make sure you are positioned to a profit if you're right. Unless you have a team of analysts working for you, when you find a stock that fits your fundamental criteria, you are going to want to own a large chunk of it. As a result, investors who use fundamental analysis may have large exposure to individual companies. This concept contradicts the idea of diversification, which is owning hundreds and hundreds of small pieces of many companies. With diversification, you are spreading your risk over many companies, so if one has a problem, it does not hurt so badly. Fundamental analysts, though, think that owning just a few investments that you know inside and out is actually safer than owning everything. Making money with fundamental analysis. Face it, you are probably not reading this book because you have a deep yearning to understand how to read and analyze company information. You are looking to dig into company record for a reason, which is most likely to make money. Remember, fundamental analysis can be profitable if you are able to find hidden value in the company or its stock and buy in before other investors discover what you know. You will cash in once the rest of Wall Street catches up to you. Putting a price tag on a stock or bond. If you have ever wondered whether a stock is cheap or pricey, fundamental analysis can be a big help. Fundamental analysis helps you understand exactly what you are getting when you buy an investment. Here is an example to help you see what I mean. Let's say you have the opportunity to buy a tree that literally grows dollar bills. Sound great, right? How much should you pay for the tree? You might be tempted to pay millions of dollars, especially if others have their wallets out and starts bidding. But fundamental analysis can help you intelligently put a price tag on this amazing plant. By asking some question and doing some due diligence, you can actually arrive at a correct price. The farmer tells you the tree grows $21 bills every month. He also says the tree will likely die in a year and then stop growing money. Lastly, the farmer promises to pay you $20 a month if for any reason the trees stop growing money in less than a year. Suddenly, this trees grows money does not sound so wonderful. Knowing these fundamental details, the tree can be priced. You know how the tree is expected to generate about $240 over the next 12 months until it shriveled up and dies. So, is the tree worth $240? Not so fast. Remember, the tree won't grow the 240 right away. You have to wait a year to get the entire weight of cash, as you will only harvest 20 a month. Because you have to wait a year to get the $240, the tree is worth less $240 just because of the time value of money. A key principle to fundamental analysis, which essentially means a dollar received now is worth more than one received tomorrow. So if there is bidding war for the tree that drives the price over $240, you know to walk away based on your fundamental research. Being profitable by being a contrarian. Being a successful fundamental analyst can be pretty lonely. If you are trying to make money from studying a company and determining the company is worth more than its stock price, you are betting that other investors bidding for the stock are wrong. Fundamental analysis, therefore, is somewhat at odds with the efficient market theory. Efficient market theory says that trying to beat the market by picking winning stock is futile. The strong form of the efficient market theory says that all information that's know evil about a company is reflected in a company's stock price. So let's say that after reading this book, you dig through a company's financial statement and find that a company has great prospectus. Efficient market theory would suggest that you are not the first person to discover this and that other investors have already beat the stock up with the same information. But before you throw your hand up and give up on fundamental analysis, there are some caveats to the efficient market theory worth nothing. Most importantly, while a stock may reflect all information over the long term, there can be a short-term period when price might excessively rise or fall due to extreme and fleeting optimism or pessimism. For instance, many high-technology stocks skyrocketed during the late 1990s as investors bid up share price on the idea that they would be worth a fortune in future. Fundamental analysts looking at the fact many of companies did not make money and never would avoid the dot-com bubble. Eventually, the fundamentals caught up to them and many of the stock collapsed 90% or more. In some cases, the companies completely failed. Remember, to profit from fundamental analysis, you have to be comfortable going against the crowd, or in Wall Street parlance, being a contrarian. When other investors are overly enthusiastic about a stock, they bid the price so high that it's practically impossible for anyone to make money. A contrarian would not be buying those stocks. Fundamental Analysis Toolbox. One of the great things about fundamental analysis is that you won't really need much to get started. If you have a computer and calculator, you are pretty much set. Unlike technical analysis, which may require sophisticated and closely stock chart services, most of the data you need for fundamental analysis is provided free from nearly everywhere your company. Plus, many free online services offer increasingly detailed access to company financial data, make it easy for you to download and analyze. There are three key financial documents that are the cornerstone of financial analysis: the income statement, balance sheet, and statement of cash flow. Introducing the income statement. Want to know how much a company made or lost during a year or quarter? The income statement is for you. This financial statement steps you through all the money a company brought in and how much it spent to make that money. If you have ever read news stories about how much company earned during a quarter, for instance, the information was taken off the company's income statement. Tip: the income statement is the financial statement containing data you probably hear the most about, including revenue, net income, and earning per share. You can find out more reading this important document in Chapter 5. Balance sheet basics. Want to know how much money a company has or how much it owes to others? That's where the balance sheet comes in. The financial statement spells out all the cash a company has in addition to its debt. The difference between what a company owes its asset and what it owes the liabilities is its equity. The basic formula is asset is equal to liabilities plus equity. Tips: sometimes it's helpful to understand corporate finance jargon by putting it in personal finance terms. If you have ever calculated your personal net worth by subtracting all your loan from all your saving, you have essentially created a balance sheet. Figure 2.1 shows a favorite way to look at the relationship between assets, liabilities, and equity. Think of the company's financial position as a square. Next, cut the square in half. The left hand side of the square, which we will call the asset, is worth the same as the right hand side of the square, which we call liabilities and equity. The left hand side of the square must always equal the right hand side of the square. Remember that liabilities and equity don't have to equal each other, but they two together must equal the asset. Getting the mojo of cash flows. One of the first things fundamental analysts need to understand is that earnings are not necessarily cash. Accounting rules, for instance, allow companies to include in their income statement revenue from products they have sold to consumers but have not actually collected dollars from customers yet. Yes, you read that right. A company might say it earned $100 million, even though it has not collected a dime from customers. This method of accounting, called accrual accounting, is done for a good reason. Accrual accounting is lets analysts see more accurately how much it's cost a company to generate sales. But accrual accounting makes it critical for investors to monitor not just a company's earning, but how much cash it brings in. The statement of cash flow holds companies' feet to the fire and requires it to disclose how much sold cash is coming. You see how much cash a company generated from its primary business operations. The statement, though, also lets you see how much cash a company bought in from lenders and investors. Familiarizing yourself with financial ratios, including PE. While the financial statements are universally valuable to financial analysts, they only go so far. Not only do companies tend to only give the information they are required to, the data can only tell you so much. You did not expect companies to do everything for you, right? That's how financial ratios can be very important. Financial ratios take different numbers from the income statement, balance sheet, and statement of cash flows and compare them with each other. You will be amazed what you can find out about a company by mixing numbers from different statements. Financial ratios can provide great insight when applied to analysis. There are dozens of helpful financial ratios which you can read about in more detail in chapter 8, but at this point you will just want to know the basic flavors and ratios and what they will tell you, including valuations. If you have ever heard of the price to earning ratio, or PE, you have used a financial ratio. The P is one of many valuation ratios. Valuation ratios help fundamental analysts find out if a stock is cheap or expensive by company comparing the stock price to a basic piece of data about a company. For instance, the PE ratios compares a stock price to its earning. The higher the PE, the more richly value a stock is. Financial health. If a company is no longer a going concern and is not functioning, it's not a great idea to invest in it. Some ratios, called liquidity ratio, measures how easily a company is able to keep up with its bills. Fundamental analysts will look for a red flag that a company might be about to face some tough times. Return on investments. If you're going to give your money to a company, either as a loan or investment, you want to make sure you are getting enough in return. Return on investment ratios help you determine how well the company is putting your money to work. Operating performance. The more a company can increase its sales while at the same time lowering costs, the more profitable it is. This balancing act is the essence of business, and the stake for investors are views, because the more profit a company generates, the bigger price of the fee that's left for investors. Operating performance ratios let you quickly see how well a company is managing its cost and increasing sales. Tip: all the type of ratios and financial measures above the best understood when you put into context. Fundamental analysts typically compare financial metrics to those of a company's rivals. It can be useful to have financial data not just on the companies you are interested in, but on the industry for comparison. This is the end of second chapter. We will see chapter third in next video.